we are really privileged to have three of them here. So without further ado, I'm going to invite all three of them on the stage.
Hi, good morning, everyone. So I have the privilege of sharing the stage with these two prolific investors, and I should say one of them rejected me in my early days, and one of them did not. So I'm glad. Yeah. So just for all the early founders here, you will face a lot of rejections, but that's okay. So I'll start off with the core topic, the summit for today, D2C, and try and take both your inputs on it. D2C is really sort of in the last 5 to 7 years, according to me, evolved. I'm really not quite sure what it even means today. And companies have performed differently, definitions have changed. So my first question to you, Vani, is in the last 5 to 7 years, what has changed, what has worked, what has not worked? According to you, how do you define D2C?
The definition, like you said, has evolved, and maybe all of us carry different definitions of it, slightly based on the lens with which we look at it, consumer versus investor versus founder, perhaps. But to me, D2C simply means how much the brand has a direct connect and understanding of their customer, largely in a traditional retail model. That was not always the case. Some brands did better than others, but they didn't understand their consumer to the degree that today D2C models allow you to do. And what that has done in how it has evolved is the consumer has deepened, right? The consumer profiles has deepened. Your ability to target the consumer has become much more algorithmic, and your ability to reach the customer has been democratized. There are many channels through which you are able to reach the customer directly. So anyone who's able to establish a deep connect and brand in the purchase decision of the customer, to me, is a D2C company, right? And how it has evolved, I think we have always had a plethora of brands, so to speak. Maybe some of them were more local. I mean, you take soap to atta to whatever the, most of the commodities. There were, of course, always national brands, but there were local brands and, different distribution channels and so forth. I think today there is just a renaissance of brands that are out there, and new categories that are emerging. Male grooming. I don't know what products you and Prashanth use. Certainly, female beauty products have just grown a lot, and every category, right, you can think about. There is a choice for customer. There is a convenience for customer that didn't exist before. There's different bands of price point for the same category of products. So I think we are in an era of renaissance of brands. Of course, what survives, what doesn't survive is a very different question. It's a very exciting time is how I see it.
Awesome. And because it's proliferated into so many meanings, so many different things, different channels, different... So why does this name of D2C stick, direct to consumer, in my mind? Very simplistically, I run an insurance business, and my understanding of direct to customer is disintermediation, right? Like going directly to the customer and having that... one, of course, money, like you said, direct understanding of the customer, because you're dealing directly with the end customer, getting data on them, understanding their preferences, and creating, that value chain, removing also that cost, which could allow for, better margins, better products, and so on and so forth. So I'll jump to you, Prashanth. So why do we still call it D2C?
I think I see D2C as a kind of an entry starting point to build brands in the country, right? This being able to address this digital first persona and use the aspiration value that comes from these digital first personas and the influence that these people can provide is what really differentiates a D2C brand. That's the starting point, right? So, and that influence that you create, which is generational, usually a generational shift. So there is a generational shift element. It could be a beauty product, it could be an ice cream, it could be an insurance product. There is, you start with a new buying audience, and typically this buying audience is in the 25 to 35, and the influence they're able to provide, because people look up to them as the influencers. So it's not about being influential on a meta platform. It's about the influence these people have at home. It's the influence they have at friends, and the fact that they are cool. So that element of D2C is an important one. The second aspect of D2C, like everything else in India, is determined by the in a sense, the market cap that is possible by being pure, right? And in India, for everything, we redefine it in multiple ways, right? So, so it will never be D2C like anywhere else in the world, because there's only 10 million or 15 million audience, which is pure online, or the other for, I mean, even by 2030, if you take 30 million consumers, for most categories, 80% or 70% will be still offline. So then what, but at the same time, you started with D2C. So the evolution of a D2C brand to still maintain that customer connect, like you said, maintain that disintermediation moat that they have, and in many cases be full stack and deepen that and improve margins. I think a combination of all of this make them successful brands that might start as D2C, but then evolve to being a very, very different animal. And in fact, there are marketplaces today with private labels that you can say masquerade as a D2C brand. And globally, you will not see a marketplace. So a marketplace could be just their own curated brands, right? That you will not call anywhere else. They call them as D2C. So that itself is, so there's really, I mean, I can go on and on, but it's like everything else in India. We'll redefine everything.
So what I understand from you, Prashanth, is nebulous. You start a little bit with, maybe not a little bit, you go direct, build some preference,
digital,
build a little bit of a name, and then you figure out
and the audience that you start with is important.
Narrow the audience,
and they should be the audience that set a trend, right? So you use all those elements and then compound from there.
Okay, so I'm gonna take a follow-up question, Vani, if you agree with what Prashanth's saying, and I say this as a founder, one of the and hopefully for the benefit of other founders here, a critical question that we face when we are starting off is control versus growth versus variabilized growth versus fixed growth. So what I mean by that is, if I take Prashanth's opinion, it's fairly difficult in the initial days to get your brand, your cost of acquisition right when going direct, right? People have to understand your brand, your product. You are also sort of subject to the Google tax, the Meta tax, in some sense, to bring traffic to your website or use influencers and so on and so forth. And you have that option of going direct, and then you have the easy ability of probably just getting your product on a Blinkit or a Instamart or an Amazon, and suddenly you don't know who you are, and those channel choices start to dictate your finances, your strategy, and so on and so forth. So channel choices versus the brand and versus the sequence of this pathway is very difficult for founders to maneuver, because variabilized growth of putting your product on Blinkit or Amazon and just trying to get, of course, is a cheaper start, but then you lose something. And so how do you navigate that initial build out?
The story of how you build a brand, I think, is the channels may vary, but I think it's eternal. Some principles stay the same. To me, ultimately, as Prashanth was saying, maybe in your initial narrow focus, you will have to understand who are your lead customers, that will be your ambassadors, whatever channels you use for that. Though there is a Google tax and a Meta tax, the question is, how effective and efficient you are in building that customer. The more you are in a discovery of a customer and you can't have that direct channel, that becomes more and more expensive, right? But ultimately, maybe it's doubling down on what Prashanth said, and not as much a disagreement, but all the way to even becoming a retail brand, right? You will have to figure out, as scale happens, how you play in multiple channels. You look at somebody like Nykaa, though they are of course a marketplace, but then they have their own private labels. But now the growth is coming from retail, right? So as you scale and compound, you will have to play all the channels as much as you can. Now, by the way, D2C doesn't necessarily have to mean you only have to be a digital brand. In India, maybe just pure play digital brand may be difficult depending on the kind of product that you are. Although there are some that have scaled reasonably from just being digital only brand. But how much of your initial target customer unit economics matter? Yes, everything is expensive, but if you are going to build it in a way that you have no advantages, then you are not going to be successful, right? You have to figure out what are your core advantages. Why does your brand pull? And what is it that whether it's some neuroscience tactics of impulse buying that somehow to target, or something else or the other. How do you understand need and situationally be able to pull for the customer? And depending on the product also, look, if you're Wakefit or sleep company, it's not that the brand building is very different, right? Whereas if you're selling, protein powder, right, Whole Truth or something, then it's a very different approach. So we can't take a paintbrush and paint one story. So it depends on your customer, it depends on your product, it depends on your ARPU, what is the right marketing strategy and how you reach your customer. But ultimately, if you look at any of the successful brands, and I think there's a lot to learn when you study success, there's also a lot to learn when you study failure, what didn't work, what really worked for somebody. In India, ultimately you will evolve into an omni-channel.
So, and there are different definitions. Maybe we'll carry the thought forward. In my mind, one of the great success stories we've seen recently gone public is Lenskart, right? Like, you could call it a direct-to-consumer business. They build their own brand, supply chain, full stack, started digitally, and then went to stores. Now probably offline stores are a larger part of their business. So I don't think omni-channel, and I'll correlate this with my personal experience. It's about whether the brand loses leverage to the channel or whether it still continues to hold that leverage. So Lenskart controlling their own stores and controlling their digital interfaces as the real estate where customers come is a long cycle, but a fruitful cycle, as we've all seen. Initially, however, like I said, it's a tough decision. Eventually, everything is omni-channel. So initially, if I'm a young brand, what should I do? If I had $100 of marketing and I don't have the ability to open stores, go omni-channel, go direct, is there a philosophical way I could approach how should I use these $100, not losing channel leverage, not losing my options, versus completely becoming sort of hostage to some of the channel economics? How do I take this decision as a founder? What's the right time to take? When capital is available, of course, I'll do all omni-channel. But initially, that's the tough phase.
From a 0 to 1, I would say today you have more choices than ever before, right? But you have to calibrate those choices. For a lot of the fast-moving products, it's very easy to start with quick commerce today, right? But the risk of starting with quick commerce is that one, there's a lot of control which the platform has, and unlike Amazon, and at least this is what my experience has been. Unlike Amazon and Flipkart and some of those, where they did not force you to actually spend a lot of money on the platform and keep your economics to unviable in an unviable place is so it's like you can test and get your product to some level with quick commerce, but I found it difficult for most brands to build great economics on quick commerce. So over a period of time, either two things happen. One, they expect you to spend more money on the platform. Second, they'll create private labels very quickly if your brand is working. And number three, they will always prop up somebody against you so that you again spend more money. So be very careful while that 0 to 1 looks like, because we get a lot of brands that show tremendous uptake on quick commerce, but I know the longevity of that is really suspect. And if you see the history of the last 2-3 years, there are not many brands that just on quick commerce have been able to get to a lot. You can use it as an adjunct channel. You can use it as a complementary channel. Definitely take advantage of it, but don't think that that's where I will spend all my money. So you still have to do the heavy lifting, the work of getting direct connect with the customer, and still be able to do that well and do that right. And that's what differentiates. And different, I mean, Super U, for example, is a protein brand, right? They've done it their own way. So I think you need to have that wedge. You need to have that real lever that is unique to you, that creates value for whatever money that you spend in that 0 to 1 journey. So that is still a huge differentiation, and that's the reason why many people succeed and some people don't succeed when it comes to the 0 to 1. Because if everybody could go to quick commerce and build it that way, then it's a repeatable playbook. There's no differentiation with anybody, right? So it looks like there is something beyond that in the way you architect your approach, and in the way you architect how you relate to the consumer, and why the consumer picks you over the traditional incumbents, and why you disrupt that particular space. That is very, very unique to a category and very unique to an approach that everybody takes. So some heavy lifting there, and it's a very creative, subjective formula. And
Judgment, lot of
it's a
judgment.
lot of judgment, and I don't think. And so this is why I think new very, very iconic new brands will be built differently from how another iconic brand got built. So it will never just be the same playbook. So that's why you just don't copy that, right? Then finally, I think there is a lot of shift today happening just in terms of the quick commerce playground itself. So I think you can kind of use it to your advantage, and I think there'll be not 2 players. So it looks like there'll be at least 4 to 5 players in that space. So you can get local dominance, right? And then understand in a very, don't try and sell all over the country on 5 quick commerce platforms. Use one of them. It's okay to kind of marry yourself to one of them initially, so that you kind of hone in your customer, understand, and then quickly try to kind of break out and don't get over dependence. And then finally, the traditional channels like the GT channels and some of those, I think are still relevant. While premiumization is what everybody is going after, I don't think it's the last word when it comes to every brand, right? So you will have price architecture, and the way you determine the price value equation work. I mean, it won't work for maybe the top 10 million, 15 million, but when you're talking 100 million people, I think some of these 50-60% channels that which control 50-60% of the Indian consumer, how you can tackle them is difficult, but I think they build big moats. Of the top 10 consumer brands, less than 2 have cracked GT in India today. And that differentiates them because it kind of, it's very difficult for anybody else. It takes them 3 years to crack GT, right? So there are these other nuances that you need to also see. Where do you put your money? Do you put your money on more spend on quick commerce, or is your brand architecture and the price architecture allow you to use GT and slowly you build moats there? Long answer, but it's
No,
complicated.
I'm just summarizing. There's no sort of repeatable playbook. If there is, you're likely to lose more than win. You need to figure out your own architecture, your own understanding, own channel understanding. So I'll move out of the operating piece to the capital piece, the capital raising piece. So what are vanity metrics that you see founders pitching to you, which you would, request or advise the audience to avoid? And the second thing, at least across all the, this from a capital raising perspective, we've seen different kinds of brands or consumer brands being built. Some are, reach the stage of PE funding and listing, and then some probably could have remained more founder-owned, 3, 4, 500 crore brands. How does the founder identify what sort of capital do they need? Should they be more bootstrapped? Is it a family office business? Is it a VC investable business? Is it an IPOable business? How do I figure that out, depending on the category that I'm in? And how do you as a VC judge that? Yeah,
We'll both answer this
Yeah.
because, but you had brought up Lenskart, right? Now, is it a VC investable business, let alone a PE investable business and IPO? Those are all progressions in the capital. Automatically, if you are looking for VC capital, somewhere at least you need follow-on PE capital, if not an IPO, right, to grow. So, so they are mile stops on the same road. However, bootstrapping could be a different path. Now, much before that, anywhere locally, you had eyewear stores, and maybe in a locality, a micro entrepreneur could have had 4 stores, 10 stores, or 1 store, but that was the predominant model. And in fact, if you take many businesses like pharmacy, that was also the predominant model. It's not that, pharmacies didn't exist, but what Lenskart did as a founder, what Piyush did, is to envision creating a aggregation at scale, and the economics that come from that kind of scale being passed to the customer. Apart from the economics, there is a trust, brand, and a certain business model that they pioneered, right? So that becomes a VC fundable business. So the question of, I also have a eyewear store, I have 10 stores, why am I not getting VC funded, is not the question. As a founder, what is the scale economics and a scale model that you are aspiring for? How does everything you do, even from your, first $1 million ARR or whatever it is, showcase a directional to that scale, right? So that's what makes maybe what appears to be a generally a limited, bootstrapped, perhaps lifestyle, profitable business to what becomes scale. Scale has to have its own moats, right? So a lot of whether it's VC funded or not starts from the founder's vision and how they execute that from or construct that into their business architecture from the very, very beginning, from my perspective. And this question keeps getting asked, as you know, Varun, often. There is a notion that VCs are very mercurial in their funding, and maybe they are. And
It should be. Yeah.
so, but I think they have their own method to their madness. It has to do with, do I see this business is going to reach a certain scale metric where it becomes viable for a VC capital to actually make capital, right? So that's as simple as that. We are all in this with a certain purpose, and that purpose for VCs is, can we make money for our investors? And that very simple thing sometimes gets lost in the discussion, okay? very quickly on vanity metrics would be GMV. That is the most, vanity metric that I see, and there are many others that follow that. But
So maybe there's 2, 3 interesting things I can say here, Vani. One, I think people like me and Vani, I think, are no longer the folks in our own firms making decisions on which D2C brand to invest in. So I think we are the wrong people. Okay. I think it's
They're trying to get off the hook, by the way.
no, it's the no, it's the 30-year-old, principal or young VP in our funds who I believe, and rightly so, understand the consumer better and make those decisions when it comes to these new brands. But anyway, so the important thing is there's 3 archetypes, and of all the things, I think the diversity of the options that exist for entrepreneurs, I think D2C is the one with the largest breadth. There are VCs who are 25 to 50 million dollar size funds, right? There are VCs who are 100 to 200 million dollar funds, and then of course there are VCs which are $500 million plus funds. So the first category is really happy with the return you will get on a D2C brand that gets to about 100 crores. So for me, as an entrepreneur, just put this on a paper. The day you build a 100 crore brand in this country, you will get bought out. You'll get bought out by ITC, you'll get bought out by Unilever, you'll get bought out by somebody, by Wipro. There is enough consumer aggregation brands that are getting aggregated. So build a profitable 100 crore brand and you will have a good 4-5x exit. That's the first archetype. The second archetype is a brand that gets to about 300 to 400 crores. Maybe it'll be a little bit of more tougher sell in terms of, because not too many people, because then you're talking about 2,000, 3,000 crore acquisition, not many options, but still a reasonable number of options. And the next stop then is 1,000 crore brand, which is what Vani was talking about, which is a classical, I mean, all of us, when we invest in D2C brands, the first question we ask is, can it get to 1,000 crores? If it can't get to 1,000 crores, or you know what, then it's not a $600-700 million IPO, even if it's not $1 billion IPO, so then is it really worth investing? But like I said, the good news is this is one category where there are VCs across the spectrum. So you will, as far as you keep this 100 crore threshold in mind, there are buyers for you. And then finally, I think there is also this challenge that I'm seeing of across many categories. It's starting to get very noisy. And because there are so many investors, once there is so much money chasing the sector, there'll be more entrepreneurs trying to do the same thing. So how do you find new trends, right? And catch on to something where somebody says it's too early. Pet care is too early. A clean label, a whole truth kind of brand is too early. So as an entrepreneur, how do you kind of triangulate the Indian consumer readiness for this trend? And usually it's a global trend, right? And kind of be first to the game and do it, like I said, with the right playbook, right? I think that's the whole deal. So that will be the big thing, right? Can you get a trend that is globally emerging? Be the first one to get it to India and make sure that in India, you're not too early. So yeah, there are many ifs here, but that's what makes you unique and will get your startup funded, right? And to do this, you have to get initial momentum. So if you don't show in that 0 to 0.5 huge momentum, We doesn't matter what fund of what size, they won't pick you up. Yeah.
I just had a thought when Prashanth was talking. The other day, a principal in our firm was sponsoring or championing a company that he said sells to Zen Alpha. I'm like, what is Zen Alpha? I thought I was up with things. I know Gen Z. Where are we going with this? And so he's right. Sometimes, there are things happening in the market, and all of us aren't. How many people have heard the word Zen Alpha? Okay, fine. Some at least haven't heard. So there are friends in the room.
I think there's one more after that also.
Zen
now.
Beta or
Yeah.
whatever. And I said, okay, so what is Zen Alpha? They told me, well, it's like 14 to 18 or whatever. I said, are they a real consumer? And apparently they are. So there are companies trying to say, how do you sell to them? And, I grew up in a world where I had no voice. My parents bought what we would use, and that was it. But, the levity apart, the depth of Indian consumer is rapidly changing, and the purchasing power, or if not the purchasing power, the decision influencing power is changing, right? So, and different people understand those consumers in different ways. Maybe understanding what is an alpha, I would have never thought about it, right? And so there is also a misnomer sometimes that you should only pitch to the most senior partner. You should pitch to whoever really champions your business and whoever really understands your business. You need champions more than you need seniority, right? And somebody is clapping, so that must have worked for them. So, don't assume that only I and Prashanth make all the decisions in our firms. Often we don't. We're also learning, and find somebody who really believes in your business. That's far more important. And, lastly, we were talking about categories. If you had only 100 rupees or whatever, a company that surprised me, it happens to be our portfolio company, but nonetheless I was surprised, is that they only sell sunscreens, right? And, sunscreen, India, it's a growing category in the last 5-6 years. How many of you use sunscreens? Well, mostly women, but there are some men. And I haven't been able to get men in my house, that's my husband, to ever use a sunscreen. It's like a male thing. I don't want to use sunscreen. But regardless, right? So sunscreen isn't a standard Indian product, even for women, now more so for women. But they are a 300 crore plus company, rapidly growing on one category. It beats all the playbooks. You want multiple SKUs, you can't be a single blah, 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 whatever. And they're a pure D2C company. So, you have to find your own playbook. That's kind of the moral, I guess, I wanted to leave with.
Thank you, Prashanth and Vani, for all the candid advice and all the lessons for all the founders. I know time's up, but do we have time for at least 2 questions from the audience? Okay, we can take 2. So, okay, yeah, the gentleman in the black, yeah.
Hi, Prashanth, thank you. Hi, Vani, and hi, Thing. My question to all of you, actually, the problem of the D2C as a consumer brands, direct to consumer brands, we are working to resolve few problems of the D2Cs. Basically, many of the D2C come to us like, to begin with, you told about 0 to 1 problems, and for that we are building infrastructure. Like going to the meta, going to the, building the brand foundation, all those things. What they are also facing is the, sorry, I don't want to lecture here, but
yeah. So what's the question? That's what we are waiting for.
They are finding in execution problem. They're not getting the execution helps.
Execution help for advertising, marketing campaigns, getting off the block. Is that what you're?
Yes, that's it. Yeah.
So I don't know whether, yeah, okay. So I'm saying this is my answer. This is not necessarily what other people should adopt. I'm saying if you're a founder who is looking for, in today's world, specifically in today's world, external agencies to help them out at 0 to 1 stage, I think you have other problems. So I don't think founders at this stage, they should be getting their hands dirty and figuring it out on their own. I don't think any agency can optimize anything for them. Only after a certain scale, yes, you can you can get there, but your brand, your marketing, bunch of these pieces, in my mind at least, should be self-done in the 0 to 1 stages, because only you know what copy will work, what image will work, how should I optimize this, and so on and so forth. In the initial days, you're the marketer, you're the product owner, you're everything. At least that's how I would look at it. Yeah.
Varun, we'll take one last question.
Yeah, lady at the back, please. Sorry. Yes.
Thank you. Hi, my name is Chandana. I'm the founder of a brand called Maya and Leela. We'll be launching soon by end of this year. It's a bridge to luxury brand. We are using Indian textiles to make contemporary designs. My question to the panel is, especially when you're working on a premium or luxury brand, how do you convert or train behaviors for your consumer to go from price sensitive to value conscious or quality conscious? Thank you.
I was really surprised by the success of Aza Fashion, right? And they have shown how you can still sell very high ARPU, luxury, and personalization, right? So because it's one thing, it's high ARPU, but it's a mattress or a phone where the specifications are understood. But when it comes to something like fashion and design and textile and something that requires some customization or personalization, can you do it online? I think conventional answer, even from a venture capitalist like me, would have been, I think that's going to be very hard. But I think they've done a great job of being able to do that. I know it because I had 2 daughters that got married about a year ago. And, they bought a lot from the site, which I had never bought. And, 1 lakh, 2 lakh ARPU even. And they were comfortable buying it. It's again a different generation that's willing to buy like that, right? So I think to your question, and Varun kind of partially already answered it, right? You know your customer best. You have a certain kind of a textile and a certain feel for it. Some customers go for it. If it's linen, some customers have a preference for that. If it's something else. So I think you have to figure out what is that customer cohort that really goes for your value proposition. That's something that's going to be very hard to script for someone else,
So the good news is I don't think you have to educate anybody. There are enough people who are educated today to discover this and appreciate those products. Your job is to find those first 1,000 customers. And that's where, like I said, just think what's your path to that, identification of that audience in whatever way. If you're Mumbai based, Bangalore based, it's going to be that first pocket of users, which you have to find affinity through your networks and get them to go. But I don't think there's a problem with education. There's enough people who are educated on that.
Thank you.
We're way above time, so we'll really have to wind up. I know there are a bunch of questions. I don't know if they're staying, but maybe if you can catch them. But right now we'll have to wrap up. Thank you, everyone. Thank you, Vani. And
Thank you very much. We would want all of you to stay back onto the stage just for a minute. Thank you for all the questions. We apologize for the questions that we couldn't take. A big round of applause for the panel, please. May I please request Deep Agarwal to kindly come and join us, please, head of payments, PhonePe, to kindly present a token of gratitude from our side. Please. We'll keep one last round of applause rolling, everybody. Thank you.